we didn't know that COVID-19 was coming, but we knew something was going to happen eventually. Like we were due for a recession.
Mhm.
Again, I didn't expect it to be this, but so everything that we bought, we purposely bought with a longer time frame, saying, hey, if we get a recession or a dip in the middle, that's okay because you don't lose money on real estate unless you have to sell at an inopportune time. As long as you can cash flow and hold on to it long enough, you will eventually come out okay, which is one of the beautiful things about real estate, because that mortgage keeps paying down, and eventually it'll get way down if you hold long enough. And again, typically, values do occasionally come down, but at least historically in this country, they eventually always will come back up. And with everything that's going on right now, it's hard. We're in a deflationary environment in the near term, but with $5 or $7 trillion of money being printed as we speak, it's hard to believe that there's not going to be some kind of inflation in the longer term, maybe 3, 4, maybe 3, 5, 10 years out. And if you own real estate, hard assets, then you're going to benefit from that.
From the inflation. Yeah. I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Today we have Andrew Cushman. Andrew, you have an amazing bio. I love it because the bio I've pulled for Andrew is so short and concise. Are you ready? Andrew is a former chemical engineer and alpine ski instructor who jumped into real estate, nice use of words, by the way, by flipping homes, starting in 2007 after successfully flipping houses right through the big crash. Congratulations. In 2011, he transitioned to apartment syndications, and in the last 9 years, he has acquired over 1,800 units. And I think there's a second piece I want to read here for a minute, if I may, Andrew. It says that Andrew solves problems by providing high-yield multifamily investment opportunities to accredited investors. Andrew is a details-driven real estate professional who leaves no stone unturned when vetting deals, probably having to do with your chemical engineer background, right? And you're very good at vetting deals, I suspect. His passion drives him forward in entrepreneurial endeavors, but his easygoing, friendly spirit is what builds lasting friendships and his investors and business partners. So Andrew, welcome to the show.
Oh, glad to be here. Appreciate you having me on.
It is great to have you on. So, give us a little bit of a background. I mean, it sounds like you were a chemical engineer, but also a ski instructor. And so give us a little bit of your background before real estate, before you ever transitioned to being a full-time real estate guy.
Yeah, well, I mean, when I was in high school, I knew I wanted to have my own business and do my own thing, but I had no idea what that was. So I knew I enjoyed chemistry and problem solving. So I said, well, that's chemical engineering. I'll go get a chemical engineering degree. I'll always be able to get a job. It'll always pay well, and I'll at least be able to tolerate the work until I figure out what I really want to do. So then came out to California, eventually got married. My wife had the same mindset. We tried all kinds of little businesses to see if we could come up with something to let us, leave our regular jobs. And, that was the stuff from looking at vending to selling t-shirt stuff online to making popcorn in our kitchen, which made a giant mess and tasted great. But all those things we realized were just going to be another form of job. Right? And would actually require a ton of work to build and scale. And then in 2006, I think it was, we saw an article in the Wall Street Journal about flipping houses, and that piqued our interest, and we kind of went and educated ourselves on that, and eventually did our first deal in 2007.
Okay.
We just purchased a condo, which we, fixed up and quickly resold. And when we sold it, we made basically as much as I made all year at my job. And we said, all right, this, there's no better, this has got to be it. There's no better time than now. We don't have kids yet. Let's, I'm going to quit and go full time. I did that. My wife joined me 2 years later. We flipped full time for about 4 years, right as everything was collapsing in the financial lockup of 07 and 08. It was a great time to do it because we had no competition and everyone else was afraid of real estate. We had really good years in 08, 09, and 10. And then, we felt the market shifting. Everyone else was realizing, oh, hey, this flipping is a good thing to do. Equity was gone or was disappearing. And so we said, well, what's going to be the next big thing? And what when we thought about it, we said, okay, well, everyone who just lost their house, they can't buy another one for 5 to 7 years, so they're going to go rent.
Mhm.
The other half of the population doesn't want to buy a house because of what they saw everyone else go through. And
Mhm.
then we just left a recession. We're going into an expansion. So what does well under all those factors? We're like, well, apartment complexes. So we found a mentor who had done about 800 units at the time. We learned the business from him. And then our first deal is we syndicated a mostly vacant 92 unit apartment complex out in Macon, Georgia, other side of the country. I would not recommend someone buy that kind of property as their first deal. And then
Yeah.
we've been doing it full time ever since. We stopped the flipping basically a year later. We kind of did both for a while.
Yeah.
And yeah, I've been syndicating apartments full time since, I guess, 9 years now. Wow, it goes by fast. And about 1,800 units or so.
That's amazing. So when you syndicate, give me a little bit of, I mean, okay. So you described to me how you got started, but you're, when you switched over from single family over to multi-unit and from flipping to doing multi-units, it is a different asset class. It's not overly complicated. Like flipping a multi-unit isn't that far away from flipping a single family when it comes down to flipping, like the flipping part, right? The contracting, the making the units nicer, the materials, the oversight of the construction. But being able to understand the value that an apartment building offers is distinctly different from the way a single family is priced and valued. And so how was that transition for you?
I mean, we felt it was really pretty easy. It's just a different way of looking at things. So, like and you're absolutely right. So, on a single family, if you're selling a 3 bedroom, 2 bath that's 1,550 square feet, built in, let's see, we're in Southern California, so built in the 50s or the 60s,
Right.
then you just look for, well, okay, what did the last 5 copies of that house sell for recently, hopefully in that immediate neighborhood? And those are comparable sales, and you get a pretty good estimation on what yours might sell for, based on the condition of yours versus the condition of those. So you just use a comparable sales approach. Apartment complexes are valued on their net operating income, right? So revenue minus all expenses, not including debt, but operating expenses. And then you take that operating income and apply a cap rate to it, which is cap rate. You can almost see it as being equivalent to, it's not really an interest rate, but it kind of tracks interest rates, and it's just a way of comparing market to market. So, for example, if you had a net operating income of $100,000 and cap rates for that type, that class of apartment complex in that market were just say 10%, to use even round numbers, then that property is going to be valued at $1 million because you divide 100,000 by 10%. So instead of just saying, oh, well, this other one sold for this and this other one sold for this, you look at what is for that class of apartment building, and in that market, what kind of valuation are people putting on that income stream, and that's how the value is determined. And it gives you a lot more levers to increase the value of your investment, because you're not just at the mercy of the comparable sales. There's a lot of things that you have control over. So.
Well, and that's kind of where I'm going to is, well, how do you work on what you're going to choose to improve? Because what you're really focused on is, if I can increase my cash flow by $100, based upon its cap rate, I've just increased the value of the building by $10,000 by, so what is it that you focus on when you guys do your value adds? What market segment do you focus on? What quality of units do you focus on? And what repairs do you focus on in order to drive yourself towards having a higher valued building when you're done?
Yeah, we found that the biggest bang for our buck, or where the juice is worth the squeeze, is really in the Class B segment.
Okay.
Class C, it always looks great on a spreadsheet, but in the real world doesn't work out as good as it looks on a spreadsheet. Now, in a big, what's that?
It sounds like that was your first one, was more Class C.
Oh yeah, definitely, and that's almost where everybody starts, is in
That's
Class
right. We all
C.
start there.
And then you realize, well, geez, this isn't. I don't want to live in this world, and you start moving up the ladder.
Right. Okay, Class B. I didn't mean to devalue you. Go ahead.
Yeah, no, that's right. So it's definitely Class B. And really, in the last 5 or 6 years, you could buy almost anything, and as long as you operated it halfway decent, you did okay because of rising rents and lowering cap rates. But that's gone. So, Class B is where we got the most return on our investment. And really, it very, what is the thing to do to increase the value varies by market. So that's one of the things you do is you look at the comparables and the rental comparables in the area and see what they have in their units and what kind of rents they're getting. And you can kind of break it out by component, right? So you can say, all right, well, I've got these nasty shag carpets. Everyone else has nice vinyl plank flooring. All right, so if I replace the flooring for $2,000, I can bump rents $60. And then if I do the appliances as well, now I can get it up 100. And if I do all the light fixtures and the hardware, okay, now I can get up to 110. And so you just evaluate, all right, well, if I'm going to spend $5,000 to renovate this unit and I can bump the rent $100 a month, that's $1,200 a year. Well, okay, so that's a 20-something% cash on cash return on that 5,000 that you just invested. However, if you take that 1,200 and put a 10 cap on it, you just created $12,000 in value. So you're actually getting a much higher return on your investment, and then multiply that times like 100 units in your apartment complex, and you can see how those levers work really, really well in multifamily, and that's certainly one of the attractive things about it. But generally, that's what we're looking at is items that make for a nicer, cleaner, more durable unit that people are willing to pay for. Unfortunately, things like brand new roofs would that no one you don't get higher rent for brand new roofs.
You don't.
People just expect their roof to not leak. So while you do have to maintain your buildings and keep them in good shape and keep up with maintenance so it doesn't get deferred, you want to be careful of you're not going to go into a building and fix the roofs for $400,000 and expect to get a big rent bump. So you got to be there's the deferred maintenance, which is just you got to fix it just to have a viable building, and then there's upgrades where you can get rental increases.
Right. And so when you do that, you always have, because if you got a C building, let's say, in a B neighborhood, like you said, if you manage to get a hold of a C building, you are absolutely going to have some deferred maintenance in the systems. And you're going to have to put money into that just to be able to place it as a B building, to be able to bring in tenants. I remember a client of mine was looking at an apartment building they were going to purchase. And as you walk down the driveway, it was like this abandoned driveway that had greenery on one side and a fence on the other that looked like some either industrial property or the railroad tracks was on the other side of that fence. And you kind of drove into this place and it was like, it just felt like the shining hallway, just driving into the units. And then once you got there, the area felt so blank and open, and the big parking lot and some old abandoned looking trees in the middle, and the grass was dead. And I'm like, yeah, it feels horrible. Like the first thing you're going to have to do is make it not feel like a neglected, scary, vandalized property. And that isn't going to give you a return on your money. And in the Midwest, and even not in the Midwest, it's, you can do Arizona or even Washington State. You can't really bump up rents aggressively without being priced out of the market pretty quickly.
Yeah, and getting back to what you said, curb appeal and especially landscaping, that is one of your best investments. Now it might be a little hard to say, well, if I redo the landscaping, I'm going to get X dollars a month in rent. It's a little harder to quantify, but if you've only got so much to spend, and it's either do it on the outside or do it on the inside, do the landscaping and the curb appeal first. Because if people have the experience that you just described, they're never going to even go inside to see the inside of the unit. At least if you have an attractive exterior, they have a chance of saying, I'll go ahead and rent this once they walk in the door. But if they never walk in the door in the first place, then you never have a shot. So yeah, landscaping is actually, that's one mistake I see people make is they really skimp on landscaping. And that is a way to really stand out in a positive way, and then and get people in, and it just conveys a message that, hey, this property is well cared for and is operated professionally and looks nice. So.
No, I have to agree, and that makes sense. What other, given that you're focused on the bottom line, there are some tips and tricks that a lot of flippers use, apartment buildings, Vantage Point, right? Obviously your company
Mhm.
would use to be able to maximize the return. So, some people it's laundry, it's taking it so that you don't have a laundry room. You have some units that have laundry in the unit. For some people, the way they bump it up is they do either a nicer carpet or a granite countertop instead of a formica countertop. It's
Mhm.
quality, because there's only so much you don't really increase the square footage, right? You're not going to do that.
No.
So it's all about fixtures and finishes. So what other tips do you have other than like making landscaping a priority?
Well, you actually mentioned one, and that's, one of the things we look for is we like to buy properties where the units have in-unit washer dryer connections,
Okay.
because we're in, generally speaking, secondary and tertiary markets in the Southeast, so North Florida, Georgia, and the Carolinas. And what we found is we can buy a set of washer dryers for maybe, I think the last set we bought was just under, was just under $700. So let's call it $700, right?
Okay.
So we can buy that for $700 and then lease those to residents for anywhere from $40 to $50 a month.
Right.
So if we buy it for $700 and then we lease it to them for $50 a month, well, that creates $600 a year per unit or per set of
Mhm.
extra income. So the units pay for themselves directly in just over a year, right? So 14 months.
Right.
However, once again, you've created another $600 of annual income, and the property is valued on the income stream, right? No one's going to come in and say, oh, that's from washer dryers, that doesn't count. It doesn't work that way. It's all that ancillary income that you can
Yeah.
create at the property that counts as the value of your property. So by buying a $700 washer dryer set and create an extra $600 a year in income, again, at a 10 cap, that adds $6,000 of value. So you spend $700, you get $6,000 in value plus $600 a year in cash flow.
Mhm.
So even if those things break and die in 3 years, it doesn't matter. You go ahead and you replace them and you put in a new set. All right. So that's, that's a great way to do it. There's all kind, there's other ancillary services people, generally in some of the, maybe B upward properties is you can do like trash valet. Vending is a small one, but again, it still adds on. There's all, just any kind of, you can partner with local businesses, right? Say, hey, give our residents a discount, and they'll come in, that just anything you can do to also just to retain more residents.
Mhm.
It's not always just about more generating income; it's cutting expenses. So the more that you can do to provide amenities, and again, if you're starting out and you're buying a C property, it might not have a fitness room, it might not have a pool, it might not have all this stuff, and so, well, geez, what amenities can I do? You can service amenities, and even if you don't directly get an income stream, your C property is probably going to be doing those. If you're doing those things, most of your competitors probably aren't, and that's going to help resident retention. Which, number one, keeps more income just because you don't have the vacancy. But two, one of the most expensive things that you incur, especially in C property, is turnover. Generally speaking, when people leave those units, they don't always leave them in the best shape,
Yes.
right? And so if you can just keep
Yes.
people in those units paying rent, you can eliminate a huge amount of expense,
Yeah.
and that adds to your net operating income and thus to your valuation just as much as if you raised rents by an equal amount. So
Yeah.
it's both sides of the P&L.
So service income. So what do you said you used a terminology called service income. So what are some of those service-based income factors?
You can do things like, a real common one is cable and internet, right? You can buy it for, and as a community, you can strike a bulk deal
Hmm.
with the service provider, get it at like half the rate that a normal person would be able to get it, and then you provide it to the residents for an amount that's in between that, right? So the resident's paying you as the owner more than you're paying the service provider, but the resident is still paying less than if they went and got it themselves, right? So everybody wins. Again, you can do stuff like trash valet. Say, hey, for $5 or $10 or $15 a month, if you put your trash out in front of your door Tuesday morning and Thursday morning, someone will come and take it and throw it in the dumpster for you, right? You don't have to do it. You can install, and then there's revenue sharing. So getting back to, like I was talking about before, you can have like like a pet washing company come, once or twice a month. They show up and they, provide, cleaning services for all the cats and dogs on your property, and maybe they give you 10 or 20 or 30% of the revenue from, when they came. And so you're not having to invest in, you're not having to have an expense to generate that. You're just partnering up with somebody. So it's a service amenity and a service income stream. It's kind of like the vending, right? In most cases, you don't buy your own vending machine and stick 6,000 Pepsis in the closet and do it yourself. You typically just hire a third party to come in, provide the vending machine, stock it, and then they just give you some of the revenue. And you can do the same type of thing with a myriad of other services and business, just based on the market you're in and the demographic that your property is serving.
So what's your guys' particular formula? What's the best building that you guys like to try to buy? What's your particular strata or market that, whether it's secondary and tertiary, I got that outside of California, probably outside of major cities. So not Chicago, not New York, right? Definitely not Manhattan.
No.
Right? So secondary, tertiary, working class, right? So B level. What else? Is there any particular structure? Less than 50 units, over 150 units, 2 bedrooms? Like, what do you like to see as far as buying in?
Yeah, there are definite parameters that we look for, and one of the beauties of real estate is there's so many ways to do it that you can have a completely different strategy and it's going to work just as well for you.
Yeah.
For us,
Yeah.
again, we like that. We like that B to A minus property. We like the secondary, tertiary markets. We're generally looking for properties that are between 100 and 230 or 240 units.
Okay.
We find we can get good economies of scale at that size, and then also we always like to have properties that can support full-time on-site staff.
Okay.
It gets much more difficult to find professional property management when you start getting down below 60 units.
Mm-hmm.
And it also gets much more difficult to economically support full-time staff, which means you might be sharing staff with somebody else, which means they may not be available when needed, or you're going to start relying more and more on third-party suppliers and vendors. So instead of having your own maintenance guy to come in and fix a leaky faucet, you got to hire a plumber, and that's going to cost you 8 times as if you just had your own guy that you're paying by the hour.
Absolutely.
So we look for stuff that we'll go as low as about 80 units, but we prefer to be between, again, 100 to 230. We've owned as much as the biggest property we owned was 350, and we actually didn't like it. We felt like as far as repositioning goes, it was kind of like trying to turn the Titanic. We felt like it just wasn't quite as nimble as we wanted it to be. And also, with 100 units, you're hiring a property manager. Well, when you've got 350 or 450 units, now you're almost hiring a city manager, right? That person's got like eight or 10 staff under him. There's like all kinds of things going on. It's a different world. And again, there's operators that thrive on that kind of thing. But for us, we just found that we didn't prefer the giant apartment complexes. Probably some of the most important things, though, is we always want the median income in the area we're buying to be 35,000 or higher.
Okay.
Because what we found is as median income goes down, headache goes up. Generally it's higher crime. Not always the case in rural areas, but definitely in urban areas.
Right.
So crime goes up.
Right.
Delinquency goes up. Unfortunately, a lot of those folks, once you get below 35,000, again, and that's in the Southeast. If we're in California, that number's gonna be a lot higher than 35.
It's a totally different number. This is
Yeah.
the Midwest.
This is Southeast, Midwest, something like that.
Yeah.
The further you get below that income level, the more and more people can't make rent if they get a flat tire or even a small medical bill. Just people who are working their butts off just to try to make ends meet, and as soon as a glitch happens, they can't make rent, right? So it's a much harder space to operate in, especially when you get into recessionary environments like we're heading into now.
Mm-hmm.
So we stay out of the lower income for those reasons. No crime, crime has to be low. We do not buy in flood zones because if you're in a flood zone and the apartment complex down the street isn't, you are at a huge disadvantage because you're paying for really, really expensive flood insurance, and that guy up the street isn't.
And and his rents will be lower and for the same quality unit.
Yeah, exactly. And so for the same quality unit, he can have his rents a good bit lower and make the same amount of money as you would. And then also, flood insurance is a moving target right now. You never know how much it's going to go up the next year. So there could be exceptions to that. Certain, like, there's some markets, coastal markets, where everybody's in the flood zone, so it's an even playing field.
Hmm.
That maybe is, might be a little bit different. But, like, we look in, we buy a lot of stuff in the Atlanta area, and you run into that a lot, where one property was built in built near a creek that floods every 100 years, and it's in a flood zone, but literally the property 100 yards over isn't. And so that other property has a significant advantage. And what happens is investors say, well, this property just traded for 75 a door. Well, this one, I can pay 75 for this one. Well, yeah, that other one didn't have flood insurance. So yeah, you're actually not doing as well.
Yeah, it surely can, and it completely can be more. So what do you guys look for on the exit then? So if this is the entrance point, right? So you're looking in that sweet spot with a certain number of units. You're looking in, certain B class, A minus. You're looking for a certain income level. What then do you guys use to turn it around to hit your target on the way out?
Well, typically we're doing a lot of the renovations that we already talked about. And often cases, there's also a bit of what we call a management play, right? Where the property, either didn't have professional management, or maybe they did, but they weren't a right fit. I've seen situations where somebody has a property management company that specializes in Class A running a B
Mm,
minus property, right? And
right.
so what happens is they tend to run expenses really high because they're used to Class A, or they've just don't have the sophisticated systems, or they have their cousin Jeff is running it because they're doing a favor, and the guy has no idea, or they inherit, the parents passed away and the kids inherited it and they're managing it and they have no idea, right?
Right.
So that's management play, just having professional management, and knowing how to work with residents, and the city and inspectors and all that kind of stuff. So on the exit, we're looking at, number one, how much value can we create by improving management and doing renovations.
Okay.
Ideally, part of our screening process is we also look to buy in areas where there's significant population growth,
Okay.
meaning long-term demand is there. And then, of course, behind that is, well, what's driving it, right? You're looking for, maybe schools and higher education, a little bit of military, good diverse economic base. And again, and really the biggest thing is an area that's growing, and our hold time is typically 5 to 10 years.
Okay.
um
That was going to be my question.
yeah, so
Yeah.
we're,
How many years?
and part of the reason for that is especially in the last 5 years, is we didn't know that COVID-19 was coming, but we knew something was going to happen eventually. Like we were due for a recession.
Hmm.
Again, I didn't expect it to be this, but so everything that we bought, we purposely bought with a longer time frame, saying, hey, if we get a recession or a dip in the middle, that's okay, because you don't lose money on real estate unless you have to sell at an inopportune time. As long as you can cash flow and hold on to it long enough, you will eventually come out okay, which is one of the beautiful things about real estate, because that mortgage keeps paying down, and eventually it'll get way down if you hold long enough. And again, typically, values do occasionally come down, but at least historically in this country, they eventually always will come back up. And with everything that's going on right now, it's hard. We're in a deflationary environment in the near term, but with $5 or $7 trillion of money being printed as we speak, it's hard to believe that there's not going to be some kind of inflation in the longer term, maybe 3, 4, maybe 3, 5, 10 years out. And if you own real estate, hard assets, then you're going to benefit from that.
Benefit from the
Yeah.
inflation. Yeah. So I have heard, and because I'm not currently in apartment buildings anymore, but so I have to claim that this is more hearsay. I have heard that previous to COVID-19, that it was getting particularly tough to find apartment buildings with cap rates where you could actually reposition the building, because cap rates were so tight that it was just hard to find a good asset.
Absolutely. Yes. Yeah. In fact, we've bought very little over the last 2 years. I mean, we were actually under contract earlier this year on a property, and I think we had looked at 270 properties or something in
Yep.
order to find that one that we felt was actually truly a good deal.
Right.
It was very difficult. Whereas back in 2012, you just kind of lined them up and you're like, I want that one, right?
Right,
And
exactly.
it was like, oh, actually, I want all of them, but dang,
Yeah.
I can only
Yeah.
buy
Dang, I
this
can
one.
only take that one right
Yeah.
now. Right.
Whereas
Yeah.
I think we're probably, real estate moves slowly, so the ripple effects take a while to work their way through the system. I think
Mhm.
starting in 2021, and hopefully not for too long, but because I would prefer the economy do well. But starting in 2021, I think we're heading back towards more of that type of environment versus everybody going crazy trying to, 30 bids on one property. So
That would have been my next question to round out sort of that beginning part of the show, which is, what do you think is going to be happening now that we are in the middle of this, COVID? And yes, I think we're looking at an anticipation of a recession, which is not, I don't think is out of line to be able to say that. But there's definitely the whole concept, if you've been watching Ted McAvoy or Delegado. I'm just saying I said his name
Dalio,
wrong. Huh?
Ray Dalio.
Thank you, Ray Dalio. Thank you very much. You can see how good I am at this. That if you're watching them and you're following them, that you're starting to hear like this is about about if you're talking to Ray Dalio, it's a balance sheet conversation. If you're listening to Ted McAvoy, he's talking about the ripple effect and it moving out and how it's going to
Hmm.
be affecting real estate. He says in 12 to 18 months. I personally don't think it's going to take that long because I'm already seeing on the street, I'm already seeing things going for discounted prices and things being pushed down. So I don't think it's going to take that long for the effect of the coronavirus to show up. But I think of multi-units, maybe C's and D's in particular, more than A's and B's, being particularly vulnerable in this environment.
Yeah, I would say as far as I think every asset class is going to suffer,
I do too.
except for maybe gold, but in general, almost all asset classes are going to suffer.
Right.
But with that said, I will say I'd say multifamily and maybe select industrial and maybe self storage is probably the cleanest shirt in the dirty laundry.
Yep.
Meaning, I think those assets are gonna ride through this better than most others. But with that said, you're absolutely right. C and D is gonna suffer the most in this because if you look, I just saw something on Market Watch today that said that 40% of the job losses were incurred for people who make $40,000 and below.
Right.
Right. But think about it, I mean, all the hotels are shut down, the restaurants are shut down.
Yeah, it's
So most
services. It's
yeah, the bulk of the job losses are in the service industries and some of those lower, your C class residents. And then, as you move up, the luxury class A stuff, people and get into uncertain financial environments, people don't go all out and spend, people cut back. Like, yeah, maybe I can afford that $3,000 loft in LA, but you know what? I'm going to spend 2,000 instead and move 30 minutes away. So, it's almost kind of like a dumbbell, right? Where you're going to see distress on either end, but in the middle, there'll be some distress, but not quite as much. And I think the strong operators in strong locations for those properties, again, will see some distress, but as long as you have good reserves and good operations, should be able to come out of this okay. And if you can survive, then I really think there's going to be a huge opportunity to thrive on the back end. So.
I think so too. We haven't even gotten to that conversation yet about, once everything has started to shake itself out, where's the opportunity point, right? And again, it's not so that we're not talking about taking advantage of people. We're talking about, well, what will help us as investors and what asset classes will need help. What asset classes do we need to purchase? Like I explained to my daughter, because I'm a flipper as well as a professional investor and hard money lender, and have been doing this for a while and used to own units directly. I explained to my daughter that as a flipper, basically I'm like a car mechanic. I'm just taking a car that's really run down, that doesn't run very well, and families don't want to live in it because it doesn't smell very good or doesn't look very good, or it's just kind of old. And I'm sprucing it up and I'm making the engine run really well and I'm making it like new and then I'm selling it. Right. So, it's like we're fixing problems. Effectively, we're fixing problems. That's really what real estate seems to be about, is fixing a problem on a property. It's not a question about whether the property has a problem or not. We want properties that have problems because if there's distress, my job is to fix it. That's
Yep.
what I do. That's where the value is. That's the difference I get to make in making it better.
It's funny you give that analogy because one of the many businesses we tried before getting into real estate was flipping cars.
Okay.
Yep.
Well, is my analogy anywhere close, or am I so off base?
No, you're absolutely right. It was not a good business for us to get into because I mean I am the least handy guy. I mean I'm lucky to figure out how to use a screwdriver. So
Okay.
we quickly realized that, oh, that was interesting. Let's move on. So
Just move on.
we actually didn't buy anything, but we went to an auction and bid and did all that stuff. And then we're like, you know what? We are outside of our
Stay in your
outside of
lane.
our zone here.
Yeah. Right.
So,
All right. So we're talking about hard moments. We're talking about COVID. We're talking about how you got. So what was your hardest moment in investing? It's probably not COVID yet. So what's your hardest moment in investing so far? And how'd you solve it?
it was this 6-month period of taking down that first deal,
Okay.
because back in 2011, by then everyone was terrified of real estate. Lots of people had lost a lot of money in real estate.
Mhm.
And so one of many things is we underestimated how hard it was going to be to raise money for that deal in
Right.
2011. And it was, I mean, we only needed $1.2 million, which today that's I
Change.
don't want to say, yeah, I mean it's not that it's a small amount
Really.
of money,
Yeah.
but there's just so much capital out there
Right.
that it's relatively speaking a small amount. And then plus now we've been doing this, we've been in real estate for 13 years, so we have a lot more investors and all that kind of stuff. So but back then we were naive as to how difficult that was actually going to be.
Mhm.
And it nearly caused us to not be able to close the deal,
Sure.
in which case we would have lost 6 figures worth of deposit and expenses that we had incurred. So that was extremely stressful. And then we underestimated the renovation. It was a 60s and 70s built property that had been neglected for about 15 years.
Okay.
And when you get to those hard C properties like that, it's like peeling back the layers on a rotten onion, right?
Yeah.
You're like, you see that, like, okay, I need to fix this, and you take it off to fix. You're like, oh man, you take off the drywall, and okay, the studs are full of termites, and then
Right.
you replace those, and the plumbing's bad, and and there's mold over here. I mean, it's just the deeper you go, the worse it gets.
Right.
And so we dramatically underestimated the renovation. We did hire the right management, and we were able to get it filled with good paying residents. We actually you can't see it, but I've got a plaque on my wall. The local newspaper, we were on the front page of the business section because this was 2011 when turning around neglected apartments was a new thing. Right nowadays, up until a few months ago, everyone was doing that, right? But back then that was a rare thing. And so the newspaper actually came out and did a front page to the business section article about, they called it apartments get new lease on life, right? Because we fixed it up, filled it up. And when we eventually sold it, we were collecting 5 times what we were collecting when we bought it, right? So we turned it into a nice, safe little neighborhood. But the first 6 months of that, the stress involved in that probably took 2 years off the end of my life. It was rough. So that, again, I would definitely recommend, don't go buy a hard C for your first asset. Don't buy something that's got 15 years of deferred maintenance. Don't buy something that's mostly vacant, especially going into a recession. And, we just kind of estimated renovation on our own. Nowadays, we bring our contractors in and we get bids right off the bat. So, don't just guess at, we went in like, yeah, we flipped houses. We can do this renovation. Yeah, we flipped houses, but we didn't flip 92 unit properties that have been neglected for 15 years, right? So yeah, we learned, bring the contractors in while you're in due diligence, and lots of lots of other things too. So
Was there ever a moment where you went, oh, fricky frack, whatever your language is, and you went, maybe I shouldn't do this, maybe I should just stop? And what is it that kept you going?
actually, it's funny you mentioned that. I don't believe there ever was a point where we were like, we should just stop, because what we realized is if we let that deal fail, then we were probably never going to get into the business. If we hadn't closed that deal and hadn't done that deal, we wouldn't have done the next 1700. Very likely, we would not have done the next 1,700 units. So I don't ever remember thinking we should stop. I do remember thinking, holy crap, maybe we bit off a little more than we could chew, or, because we still had the flipping business going at the same time too. But it was just, we knew that executed properly, that process would work. And it was just a matter of learning and figuring out and working out the execution. And so we believed in the process that we were attempting to do. We believed in our ability to eventually learn it and figure it out. And so it was just a matter of persisting in that. People always often ask, well, how do you know the difference of when to persevere and when to quit something that you shouldn't be doing? Well, that's one way to tell is if you know other people who have succeeded in it. And that's one of the beauties of real estate is you don't have to figure. That's one of the reasons I was attracted to it. Is you don't have to learn anything new, I'm sorry, you don't have to figure out anything new. It's all been done before by lots of people, and all you have to do is corporations have R&D, which is research and development. So in real estate, to me, R&D stands for rip off and duplicate, right? And not in a malicious way, just find a way to learn how someone else has already succeeded in what you want to do, and then just go copy that, right? There's enough real estate for everyone. There's an abundance of it. It's not, if sharing information isn't going to make it so you can't do your business, right? So that's one of the things I love about real estate is it's you can look at this, you can have a roadmap laid out and know if I execute this will work. So because of that, we never really thought of quitting. In fact, if anything, it's like, what, if we do quit, then we fail, right? We're going to make a lot of mistakes and all that. And some of those were failures along the way, but we used that to learn and improve. Whereas if we had quit, then we would have lost a bunch of money and maybe never continued in the business. And then that would have been a failure. So not wanting that to happen. And we were raising money. We were telling people about all this great deal that we were doing to say, oh, never mind, we're not going to do it. We felt like, well, number one, we look stupid. Two, we're letting people down. So there was that as well. And like I said, it was far harder than we thought, but it did end up being profitable and successful. And we turned around a community that had been neglected. So overall, it felt good and turned out well. So.
All right. So last round of questions. We just talked about how hard it is to be a real estate investor. We've talked about hard moments. We've talked about it's challenging. We talked about how you're really having to be good at due diligence and turn communities around. Why do it? Like, why not be a chemical engineer? Why? I mean, you already have a perfectly great degree, right? You could have worked that job. Why leave that to join this craziness? What was it that made you want to do that? What part of your drive inside of you made you want to use real estate for your financial freedom?
Well, for one, I couldn't show up at my engineering job in sweatpants and a t-shirt, and do that from home. Two, while my job as an engineer paid well, somebody else determined what that pay was going to be. Whereas a real estate investor, or really almost any kind of entrepreneur, that's largely up to you. How hard you decide to work, how effective you work, and how well you scale your business. There's no upper limit. And one of the things I love about multifamily in particular is, when you flip, that can make really good income. I mean, I know some people making 7 figures a year of flipping, but you're only as good as your next deal. Right. You sell it, you hopefully make a nice check, and that's it. Yeah. Whereas with rental real estate, whether it's a 4-plex or a 300 unit, you have money coming in every month. And once you get it stabilized and running really well with a good team in place, it can become quite passive. Not 100% passive, but it can become quite passive. And that income will come in month after month, whether you do any more deals or not. Right. And so that gives you the freedom to do, in a sense, whatever you want, whether that's more deals, build another business, surf and ski, which, I try to get as much of that in as I can, okay. Spend more time with family, exercise more, all of those things. So those are some of the reasons, and it's not without risk. You head into a recessionary environment like this, my income's definitely going to go down too.
Yep.
But like I said, there's ways of planning for that, and fortunately, we largely have. So I feel confident that we'll make it through, and we're really kind of focused on setting up to succeed even more once we get to the bottom of this, hopefully sooner than later.
Hopefully, hopefully for everybody's sake, this is sooner than later. Thank you so much. We're running out of time. So this is where, if people want to know more about how they can actually invest with you, now that they've gotten a sense for your level of expertise, your diligence, how you think about things, and the market that you target, and also your approachableness. Is that a word? Approachableness?
I'll take it. Works for me.
Okay, I don't know if that's a word, but basically how approachable you are. Like, if they want to get a hold of you, how do they get a hold of you? Your company's called Vantage Point, but how do they do it?
Yeah, it's pretty easy. I mean, if you just kind of want to connect, there's always bigger pockets in LinkedIn. But if you actually want to have a real conversation, if you just Google Vantage Point Acquisitions, or it's vpacq.com, there's 2 buttons on there. There's to contact us. You can fill that out, submit your information. It comes to our email, and then we can set up either email conversation or set up a call. But yeah, that's usually the best way.
And if they have a building that you might like, same way.
Yeah, that's actually, yeah. If that's a good point. We're happy to look at deals that someone else has gotten under contract, especially, of course, especially if we haven't already seen it. So yeah, I would go ahead and submit that the same way.
Okay. All right. Well, thank you so much. Thank you for listening to Real Estate Breakthrough. We've had Andrew Cushman with Vantage Point Acquisitions, and thank you for being here.
You're welcome. Good to talk to you. Take care.